Whoa, everybody, happy Tuesday. Welcome to Coaching with Chris. I'm pretty excited to be able to have Gordon with me. Look, I think we're all wanting to learn more about credit reports, learning about a little bit of the back end, learning about the costs. And I don't think anyone's better than Gordon to answer that. I met first Gordon in California, and I just fell in love with this guy. I love the way he makes it easy to understand. I love his story. He's been doing this a long time. So listen, I can't wait to bring Gordon in. Gordon, are you here?
Yes, I am. How's it going, Chris?
Good. What? You got a Peloton in the back? Are you trying to tell me something?
It's there just to hang my clothes. I haven't used it for like a year, so.
Uh, look, I got in my other office, I have a Peloton sits right there, and every day it speaks to me. And
Right?
you know what it tells me?
What's that?
It says, Chris, you're so disappointing. Why wouldn't you get on?
I hear the same thing. That's why it's like right next to me, reminding me every day.
So, I mean, look, for everybody that doesn't know you, I mean, I know that you're pretty well known on the west side of the country, and as we talk through, look, if you have any interest in getting hooked up with Gordon, I'll make sure at the end and follow up. We'll get you all his contact information. But like, walk us a little bit through your journey of how you got to where you are today.
Yeah, well, thank you, Chris, and thanks for having me on your show. I mean, it's such an honor to be part of Coaching with Chris. So, thank you so much. I mean, I started my company back in 1996. So I was basically my buddies and I said, "Hey, let's open a business." We found out a little bit about the credit reporting industry. I had a friend that worked for another company, so me and three other friends got together. We started a little tiny office in San Francisco, right by the beach.
Mm.
And so we had like five customers. We worked with five small local mortgage brokers in the area. We created a software. We provided them credit reports. And within a year, it just blew up. We had about 1,000 mortgage companies we started working for, with us in a year. And within 3 years, we had about 5,000 mortgage companies working with us. So
Wow.
it just took off. I don't really, we're fortunate. I mean, we provide a great service, and we just have, existing customers spreading the word and a bunch of brokers signing up with us. So we did really well. I ran the company for about 20, close to 20 years. And then it took off even further, and it got larger, and really we couldn't really sustain the client base anymore. So we worked with other companies to acquire us. So Advantage Credit is another company in Colorado, been around for about 30 years. And I spoke to the CEO of Advantage Credit. There was a good fit, so they acquired my company, and now I work for Advantage Credit as a sales director, and I oversee the mortgage broker division, which is consists about maybe 10,000 mortgage companies that I work with and oversee. So it's been great since, and I love working with this industry. Like I said, I've been working with the mortgage industry for 25 years now, and I can't see myself doing anything else. I love it.
What's interesting is actually I didn't even know that you started right with mortgage companies from the very beginning.
Absolutely. Yep. I've seen the ups and downs and the
Yeah.
struggles. I've seen the struggles and the tribulations that the mortgage industries go through, and I have the utmost respect for anyone in the mortgage lending industry. I really do.
As we kind of dive into this, um, where do you feel on the credit bureau side more mortgage brokers go wrong?
On the credit bureau side, where do the mortgage brokers go wrong? I mean, there's every mortgage company is different, right? I mean, you have the small companies, mom and pop shops, one person shops, you have the larger brokers. There's so many different ways to operate a mortgage company. So there's no one size fit all type of operation in the mortgage industry. Plus, you have different niche clientele. You have brokers that work with borrowers that have more credit challenge. You have other brokers that work with borrowers in a different economic background with higher credit score. So it really depends really on your client base and what type of market you're going to go after, and you really need to cater your business to the type of client base that you want to specialize in. So what I see some mortgage brokers that go out and just kind of try to repeat the same things that they've been doing all along or that other brokers are doing, and it's not working for them. So really, it has to do with just catering your business, finding your niche, what type of demographics you work with, what type of client base you work with, what type of credit scores most of your clients have, and try to work around that and provide a service to specialize in that, in that client base.
Hmm. You know, I know technology has changed, and I know the cost of just facilitating things have always changed, but it seems like rent uh, always goes up. Like you never hear renting a house ever goes down, right? It never goes down.
Good. Yep.
And the one thing about credit bureaus is that it's a little different than milk. Like milk goes up and down, but credit bureaus never do. Why has credit bureaus got so expensive?
Yes. And you're absolutely right. I've been in this business 20 something years, and I've never seen the cost of credit reports ever go down. You're absolutely right. So it's in the last 20 years or so, it's been pretty consistent. The credits, the cost of credit reports goes up about $3 a year, and that's pretty consistent. This year was a drastic change. It was announced. So Fair Isaac Corporation is the company that provides the mortgage credit scores to our industry.
Okay.
And in the last 20 years, they've had an agreement with the three credit bureaus that restricts how much they can charge each year for credit report, for scores, I mean. So that agreement terminated last year. So as of November of last year, they announced that they're going to be making a change in the way they're charging for credit scores. So Fair Isaac developed a three-tier pricing structure this year. So basically in the first tier, that consists of 46 of the largest lending institutions in the nation, such as UWM, Quicken Loans, Wells Fargo. So the 46 largest lenders only got a price increase of 10%. The next tier consists of 6 lenders that the Fair Isaac selected, and they had a price increase of 200%. Now the third tier the third tier is the rest of the mortgage industry. And that's really like your small to medium-sized mortgage brokers, even your large mortgage brokers with 500 LOs, they're still in that third tier. And their prices went up by 400%. So that's what we're looking at. That's most of the clients I work with are mortgage brokers. They're seeing a price increase of at least double since last year on their credit report fees. And that's because of this Fair Isaac agreement is terminated. Now they have a new pricing structure, and they're really taking advantage of it and trying to make up for the last 20 years of not being able to increase their cost the way they wanted to.
Yeah.
So
yeah. Hey, Gordon, when somebody mentions my competition on this podcast, it's a $5,000 fine. So I'll get you my address.
Sorry, buddy.
Oh my God.
I'm gonna keep that in mind.
I think that one of the things that we always question is that the difference in scores from a mortgage bureau to other type of bureaus. I know we all know it, but like, what is the easiest or best way to be able to explain that to our clients where they're on Credit Karma or they were on something else and they're looking at that score, and then we pull a tri-merge and it comes with this score, or it was different, my score was just this when I bought a car, or what's actually happening underneath the hood?
Got it. And that's a great question, and I hear that all the time still, Chris. So I mean, scores are industry specific. Really, that's an easy way to put it. It's industry specific. So if you're purchasing a car or leasing a vehicle, then they're going to pull a auto industry score. If you're applying for a mortgage, it's going to be a mortgage FICO score. If you're applying for a credit card, then you're looking at a credit card type of mortgage score. So every industry has their own version of the credit scores, and the ranges are different. For instance, the mortgage scores range from a 450 to an 850, whereas a if a consumer goes out and pulls their credit through Credit Karma or maybe applying for a credit card, that range of the credit score might be 150 to 950. So
Wow.
it does have different ranges. It's calculated differently. There's different scoring factors. But the easiest way to look at it is really, depending on why you're getting your credit pulled, what's the reason for it, then that they're going to use a different scoring model for that specific purpose.
Yeah.
So that,
Yeah. Who's the toughest? Who gets typically the lowest score?
really the mortgage industry does.
Okay.
So that's typical that's why whenever consumers pull their own credit, whatever source they have, they go to the mortgage broker or the loan originator and they say, hey, my score is 750. I just pulled it last night. Mortgage broker pulls it again. It's usually going to be lower by about 25 to 50 points. And that's a pretty good average.
That's
So
more
yeah,
than I thought it would be.
Yeah. So the mortgage industry has the strictest credit scoring model.
Okay. So we talk about a 400% increase, that a lot of us occurred. And of course, the thing about that is that, that's directly right into the consumer. So it's just like, them going to get gas at the pump, they're going to absorb that additional expense. What are some ways that we could save some money, for our borrowers or even for ourselves? Because, I visit with brokers all the time, and we're working on their P&Ls and we're trying to tighten them up. And one of the big things is that they're incurring a lot of credit bureau charges of loans that they haven't been able to do, so they can't pass it on to the consumer.
That's correct. And that's an excellent question, Chris. And that's really the hot topic of this year so far. Brokers are scrambling to see what they can do to reduce their costs, or if they can pass on more of the cost to their borrowers possibly. But I think the most popular product or practice right now is for brokers to look at pulling soft pulls first. So soft pulls, and we call it pre-qualification soft pull reports. So basically, and a lot of brokers are still kind of unsure as to what the soft pull is. Some think that it's a condensed version of the credit score, that maybe you're not getting the FICO score, or maybe you're not seeing all the liabilities. And that's not true. I mean, a soft pull report is going to provide the same credit score as the hard pull, gives you all the liabilities, all the payment history information. So the soft pull looks the same as a hard pull. But the cost of it is a lot less. I mean, most soft pulls are going to be less than $15 for a tri-merge report, and that's an average in the industry. So if you're doing, I don't know, 10 loans a month, 50 loans a month, and only 30% of those are going to actually close, the other 70%, really, you could have saved a lot of money by pulling the soft pull first for a fraction of the cost. And then from there, you can still import the liabilities into your 1003 or your LOS. You can still work the DTI, you can still work the numbers, and make a pretty good determination if you can do a loan for this borrower or not. And if you can't, then you don't need to spend money on a full-blown hard pull. And you're really going to be able to reduce your monthly credit expense by a good 30 to 50% probably.
Yeah, I mean, I tell my originators all the time, look, 80% of them, if it's a deal or not, and you can get that by a soft pull.
Yep, absolutely.
And I, I'm I love it that the soft pull is basically the same information, but what I think is confusing to everyone is that why is it cheaper?
Well, there's some things in the background that we're not seeing on the soft pull that you do see on the hard pull. So there's a couple of reasons. Number one, the soft pull doesn't contain trended data. Trended data is a 24-month payment history that Fannie and Freddie looks at when they're underwriting the loan. That doesn't show up on the soft pull. That's only on hard pull. And there's an additional cost for trended data. That's one reason. The other reason is you cannot reissue a soft pull. So whenever you reissue a credit report to DU and LP or to a lender, there are reissue fees. There are other types of fees associated with that transaction. Because soft pulls don't have that ability, those fees are not incorporated into the cost. So the cost So the way the bureaus look at it, because the bureaus, we're paying the bureaus for soft pulls and hard pulls.
Yeah.
So they're basically double dipping, right? They're going to charge you for the soft pull and they're going to charge you for a hard pull, because you have to pull a hard pull if you're doing a loan. So there's just the soft pull is really just a preliminary report. They're not going to charge that much for it because they're hoping that you're eventually going to also pull another report. So that's why they're not. It's a lot cheaper for the soft pull for those reasons.
So yeah, I mean, to the Facebook, I can't see the name. All I can see is user. But yes, I mean, if you had an agreement with Fannie and Freddie, you can use a soft pull to be able to run AUS. They're both separate agreements, but you'd have to have an agreement. Some lenders have that agreement. Some lenders don't have that agreement. So that would be, really determining of who you're running your AUS through. But I think 80% you would know, hey, I got a deal. And the other 20%, you're like, shucks, I'm going to have to pull a hard pull, and I'm going to have to be able to run it through AUS to see if I can get this deal to work. But let's go back up one step. So let's say I pull a soft pull. Average cost on a tri-merge soft pull is $15. Then, I know that you can't speak for all the other companies, but you could speak for your company. Then now I'm ready to go. The guy got into contract. I know I got to pull. My full tri-merge. I've got to be able to get AUS run. I've got to get this file set up. What's the additional charge? Am I basically going to pay $15 more? And then, but in lieu is that for every deal that doesn't go into contract, or every deal that I know I just can't do, I'm going to save that money. Is that what you're saying?
You're exactly right, Chris. I couldn't have recapped it better than how you just explained it. So that's exactly right. So yes, I mean you do have to pay for the soft pull and the hard pull because it's two different types of report. But the savings will come with the amount of the files that you didn't have to pull the hard pull on. So that's going to still be a significant savings there. But both reports will still incur a fee.
Yeah. And to the other question, I think, Gordon, you really explained it pretty well, is that the reason why you can't use a soft pull then instead of the full pull is basically because all of the additional information is what secondary needs to do to be able to facilitate that loan, correct? I mean, or am I missing something?
Correct. That is true. And just to further clarify on that, because there was a question on this. So Fannie and Freddie, they are in a pilot where they're looking at being able to reissue soft pulls in the near future. And part of that pilot right now, there are some lenders that are, and I'm not going to mention the names.
You don't want another $5,000 fine, Gordon?
No, just there are some lenders out there that are part of that pilot and testing out the ability to reissue soft pulls. So you'll see that in a few lenders out there. Now we are also talking with Fannie and Freddie to possibly be able to reissue soft pulls in the near future, but that's still in discussion and that's still in a pilot stage. But I'm hoping in the future everybody will be able to reissue soft pulls in the future. That's at least what I'm hoping.
But it ain't for free. I mean, you're
Absolutely
still paying.
not.
So it's not like you're scooping out or getting another deal. You're still going to have to eventually get the full pull.
Well, yeah, you're right. Even when we're able to reissue soft pulls, they're still going to require a hard pull at some point.
Yeah.
Yes.
One of the probably biggest topics on credit bureaus in general is how our borrowers are getting bombarded and the whole trigger. And, let's go down that road, because I think, the more we're educated, the more we know, the more that we can figure out how to deal with it. Soft pull would be one way. But then also, I've heard a lot of brokers and even AIM, we all looked at that road, but there's really just not a ton we can do with triggers. And it's a big part of the credit bureau's business is credit leads. So let's go down the road and cover the elephant in the room, which is trigger leads.
Oh yeah, that trigger lead practice really infuriates me. It really does. I mean, that's one of the practices that I've been dealing with and the whole industry's been dealing with for a good, 2 decades. I mean, it's not new, but a lot of brokers haven't experienced it in the past. They're just seeing it happen now. And that's because trigger leads are going to be more prevalent in a climate where rates are higher, where your pipeline's drying up, and companies are now looking for ways to get more leads. So now they're purchasing trigger leads more than they have in the last 3 to 4 years. So every day I get a call from one of my broker clients saying, hey, what's going on? I pulled my borrower's credit. They got 20 to 50 calls in a day of from my competitors trying to get their business, and they're very upset, and they have a right to be upset, because this is just the most unethical practice, I think, from the bureaus. So it's something that's been going on for a long time. We've tried to stop this from happening. We can't. The bureaus believe that they own the data, they can do what they want with the data. So once credit's pulled, they see that mortgage inquiry. It doesn't matter. One of the things I hear, I'll just step back 1 second. A lot of brokers, I say, when they pull credit, they omit the name. They omit the phone number, and they omit the email when pulling credit, and they believe that might minimize the trigger leads or the solicitations. And that's not true, because when you're pulling credit, we don't pass the phone number or emails to the bureaus. That's not part of the parameters we need to pull credit. So even though you're providing it, we're not sending it to the bureaus. But the bureaus are seeing the mortgage inquiry. They already have the consumer's phone numbers for the most part in their database. So what they're selling that information regardless. And it's in real time. So once you pull credit, they may get a phone call or a text within 20 minutes from the time you pull their credit. So the only thing that the borrowers can do really at this point to minimize it is to either opt out or get on the do not call registry. So they can go to optoutprescreen.com, which is the website. It's easy to do. You can do it through you can call and do it through an automated phone system, or you can just go online and do it quickly. So it shouldn't take more than a few minutes to opt out. They can also go to the do not call registry, which is donotcall.gov. So both ways are going to be effective.
So if I opt out, right? If I do a soft pull, this is a typical probably pattern. First I do a soft pull, then I send the opt out to my client. I explain the reasons why I'm helping them eliminate chaos in their life of 30 to 50 calls and offers. Then I get the opt out. How many days does it take to make that opt out in force so that I could pull a full tri-merge?
Yes. So it typically takes about 5 to 7 days for the opt out to go into effect.
And do you get noticed?
I don't believe you get notice. I think they just tell you it's 5 to 7 days, and I don't think they're going to reach out and notify you once it's in effect. Yeah.
So you kind of got to guess.
Yeah. So wait about a week before you pull the hard pull. But that is the right way to do it. You pull the soft pull first, instruct your client to opt out, give them the reasons why, let them know that, hey, even if they do opt out, there's still a chance that other lenders will reach out to them, because that's, once you pull their credit, it's public information, so the bureaus are selling it, they may get solicited. So the best thing to do is educate your client about the practice, give them instructions to opt out, wait 7 days, and then before you pull the hard pull, and that will minimize most of those solicitation costs.
Yeah, and to the question from the user, yes, a soft pull will not trigger a trigger lead. Only a full pull will, correct, Gordon, will trigger a trigger lead. But one of the things that I'm seeing also with this is that I see a lot of LOs pushing their customers to fill out the online link, which is going into a website, which is filling information, and the internet's really smart. We look at a pair of shoes and every social media that I'm in, everywhere I'm in, I just looked at a pair of shoes, right? And it knows. So if you go into a website and fill out a mortgage application and don't take the time to be able to actually walk that customer through the application yourself, they're going to get probably triggered through social media, triggered through email, triggered in all different types of sources of information in front of them, that there possibly could be another deal out there just as much as a trigger lead with credit. Don't you agree?
Absolutely. Especially when it's online. If you're doing any type of application online, the search engines are now selling that information too. It's not just the bureau selling the information when you pull credit, but your search engine, Google, they'll sell that information too, because now they know you're searching for something in the mortgage field. So then you're really getting a double hit from trigger leads. Yeah.
Yeah, so I think it's really two things, guys. I mean, number one is that you got to go old school. Like, look, there's nothing better than taking a application either over the phone or in person. And my personal preference is over the phone. Then schedule the meeting. You're going to eliminate leads getting generated for your current borrowers. But number two, to Gordon's advice, and I want to clear the air. Gordon's not the one selling the information. Like, it's not Gordon's company selling the information. It's the actual bureaus selling the information. Correct, Gordon?
Absolutely correct. And thanks for clarifying that, because I get threats all the time. When that happens, trust me, I got a lot of angry brokers calling me whenever that happens.
You know, I think that we all are on the same page that, you know, eventually when quantum easing ends, we'll be basically set up to a lower interest rate environment. And, you know, whether that's end of the year or next year or when it fully gets here, I believe it'll be here. And being ready for that in a couple different ways. But one is getting super organized and also making sure that your clients have the best score so that when the new low rate comes, they can get the best rate. And walk us through, like, if I'm going to mentor a borrower's to getting the highest score, what would you recommend as maybe the top 5 things that we should be doing and telling our borrowers?
Sure, absolutely. Well, I mean, first and foremost, pay your bills on time. I mean, that's the number one, and it's obvious, right? But
yeah,
I mean, one late payment on any type of account. I mean, doesn't matter if it's a credit card, mortgage, student loan, auto loan, any type of account. One late payment can drop your score 75 to 100 points for that first late payment. So, I mean, that's huge. So the most important thing you can do for your credit is pay your bills on time. Okay. Now, if you're past the due date, let's say you missed the due date by 10 days. Now, you know, you might think, well, I'm already late. Let's just wait till the next month and then I'll just pay both of them at the same time. Do not do that, because, you know, once it becomes 30 days past the due date, it becomes a 30-day late that's on your credit for 7 years. So even if you're past the due date of when you're supposed to pay it, make sure you still pay it before 30 days. Okay, because you still have a window where it's not being reported to the bureaus yet until it's 30 days late. Okay, so make sure
Wait,
that
I want to go to another one.
Sure.
Like when you're talking to the borrower, Gordon, and I just learned, it just kind of hit me the other day. And we're a bank, so I seen this on the bank side. So you have a commercial loan, or that's actually filing on your personal return, or you have a personal loan, and the loan comes due. Let's say it's like a balloon, and it comes due, and you're waiting to be able to renew it. If you don't pay it, chances are that bank's going to submit that loan as a 30-day late, even though you can't make a payment yet because the loan's due and you're in the process of renewing it. And I've seen borrowers get a whole pile of lates, and they're literally waiting on that bank to renew that loan. So it's not just a late payment. Have you seen this before?
I have seen it before, and that does tend to occur during a transitionary period like that. And that's a tough one. I mean, if they don't want you to make a payment, so you don't, but then it gets reported late.
Right.
So, I mean, it's a conundrum to figure out what to do in that situation. I would say the best thing to do is document that with that particular lender or creditor. Document it that, you know, you are during this grace period or phase where you're not supposed to make a payment. If you have something in writing, maybe if the late does show up, we can address it and get it removed or reversed.
Cool. All right. So next one is what, Gordon?
Well, the second biggest thing to really keep your credit scores higher, keep your revolving balances below 30% of the credit limit. Again, so that means, and that's just for revolving accounts, so that your credit cards are your main ones. I mean, don't worry about your student loans, auto loans, mortgages. holding a high balance on those are fine, but your revolving accounts, you should have a balance below 30% of your credit limit. If you can get it to 10%, that's even better, but not necessarily zero. So the one thing I do want to caution, if you have multiple credit cards, if all of your cards are at zero balance, then that could actually have a negative impact on your credit score. So you
But
want to make
why?
sure, well, because they want to see activity. So when the credit score algorithm's running your credit, they're looking at all your revolving accounts, they're looking for activity, and if it's a zero balance, that actually negates some of that. It's showing that you don't have activity for that month. And that's a negative factor. So they do want to see you have at least one credit card with a small balance of between 5 to 30%. And the other credit cards can be zero. That's fine as long as you have one with the balance.
What about construction loans? Is that considered revolving? Because, we go in, we get a construction loan, it's set for 400,000. By the time it gets to the end, of course, it's going to be maxed because that's the time for us to do a takeout. And that's the time that a new bureau or an updated bureau gets pulled. Is that considered revolving?
Not for the most part. I mean, sometimes we see a creditor reported as revolving, but for the most part, it's reported as an installment loan.
Okay.
So if it's an installment loan, that shouldn't have a negative impact on your score if it has a high balance.
Okay, cool.
But those are the two main things, really: making your payments on time, keeping your revolving balances at a low ratio, and of course, don't have any collection accounts. Any type of foreclosures, things like that, of course, is going to be detrimental to your score as well.
I got a borrower, comes in, young kid, has done everything right, paid cash for everything, wants to buy a house. He's perfect. And sure, we can all do a manual loan for him. But how fast can I get a score, and what's the easiest way?
So if this client doesn't have any credit scores because they haven't established any credit history. So right now, the scoring model that we're on requires 6 months of established credit before someone can get a score. So if you're talking about a person that's just never had any credit, but now just started opening some accounts, they're going to have to wait 6 months to get a score.
And one tip I learned actually on my own kids, which is just create a ready reserve account on the checking account, and make sure you're on the account as well so you can monitor. And boom, put $100 on it or whatever, so it shows activity. It gives them a pretty good score right away, and you can get your 6 months in no time.
Absolutely, that's what you want to do.
Credit cards, the no duh one, but the ready reserve was really easy.
Yeah, you can do authorized user. So if your client has just started established credit, so they may not have 6 months of credit histories themselves, but if they can add their name onto someone else's credit card, maybe their parents, their spouse, and those credit cards have been open for more than 6 months, then your client will have the benefit of that whole credit history. So that will automatically give them that 6-month requirement on an authorized user account.
So the way I understand it, HELOC is revolving. I'm clearing up some questions on the side before we move on. HELOC is revolving, correct?
It can be, not always. It depends on how the creditor reports it. So we do see HELOC showing as revolving sometimes, and other times it shows as an installment loan.
So it just depends on how the bank reports it.
Does depend. Correct.
Now, the next question was, late payments stayed on your credit report for 7 years is applied to all late payments. The way I understand it is yes.
I would say yes, for late payments, yes, 7 years. But there are some derogatory accounts that stay on for 10 years, like some liens can be 10 years, judgments can be 10 years. But those no longer report on the credit report anyway, so you're not going to see that on the credit report, but you may see that on the liens and judgments report.
Okay, cool. And what I was talking about, just to clear up, is that setting up a checking account for your child, and then along with setting that checking account up, you got them a ready reserve. So if they ever became overdrawn, it would pull onto that. You can actually pull a balance onto that and dump it into the checking. You don't have to wait for them to be overdrawn, and then that could show it. And the last question is getting added as an authorized user. I remember the old days, the good and the bad, and I think you would probably be picking up what I'm laying down is the authorized user on a family, maybe a family credit card. Is that going to get reported to that family member's credit score?
Yes. So authorized user really is like a like a joint account really for all intents and purposes. Whoever's on the authorized user account is going to be impacted by anything that any of the other cardholders do on that account and vice versa. So if someone's late, it's going to report to everybody on that account, even the authorized user. So it can be good, it can be bad.
Okay. Okay. Yeah, right. For sure. Now, two new versions just got approved, and kind of walk us through that. Some might know about it, some never even heard about it, but what just got approved and how does it
Yes.
impact us in mortgage?
Yes. And then this is pretty exciting for me because I'm in this business. In the credit industry, we've been using the same version of credit scores for the last 20 years. This is the FICO Classic scores. So the scores haven't changed in 20 years. So now this new announcement that was just made last October from Sandra Thompson, the director of the FHFA, she announced that they approved and validated two new scores in the mortgage industry. That's going to be the FICO 10T and the Vantage 4.0. And so these two new scores are supposedly going to be more accurate than the current scores we're using, and it's going to be more inclusive. So the purpose is to, to really include more potential borrowers in the pipeline and help the industry by being able to generate more loans for the industry. And so one of the good things about the new scoring model is that it's going to incorporate alternative payment history. So it's going to incorporate rental payments, utility payments, Paycom bills. So it's going to incorporate more payment trade lines than the current version. So as a result, it's going to include more borrowers that normally would not have been approved for a loan because they didn't have sufficient credit or sufficient credit history. Now they might be able to get approved as well. So that's, hopefully that'll benefit the industry. And there's a few other things about some of the new credit score versions that's going to be beneficial. On the Vantage 4.0, we talked about the 6-month requirement before someone can get a score. On the Vantage 4.0, it's only a 1-month requirement. So really, if someone's starting out, all they need to do is wait 1 month before they can get credit scores. Same for foreign investors. If you're working with some foreign investors, they're coming in from a different country, just starting out their credit, they don't have to wait 6 months to get a score. They can, after 1 month, they can get scores. So that's going to help quite a few brokers too, especially those that work with foreign investors. Last thing about the new credit scores, it doesn't factor in paid collections, and it also doesn't factor in medical collections that are less than $500. in fact, the current version of the score has that component also. Starting April of this year, so this is brand new, right, fresh off the press. Starting April of this year, the current FICO scores, they won't factor in medical collections that are less than $500. So there's a lot that's going on right now with the FHFA and the GSEs to try to make the credit score versions more accurate, more inclusive, and really try to generate more potential borrowers for the industry.
Yeah, I don't know if everybody caught what Gordon said, but number one, just clear it up. It's the FICO 10T and the Advantage 4.0. That's the two that he's talking about. But look, if you had a customer prior to April and had some medical debt in there and you knew it was affecting their score and you couldn't get them approved, guys, I would be going back in, getting authorization and seeing if you get them reapproved with the new score effective in April. This is a great opportunity for us to work on some deals that we possibly missed, huh, Gordon?
Absolutely. So to clarify, the two new scores are not going to be implemented probably for another year or two. So that's not, the April is really the current scores that's just changing their algorithm to not not factor in the collection accounts or the medical
Paid
collection
collection.
accounts. Paid collections are not going to be counted, and medical collections that are unpaid but less than $500 are not going to be factored into the score either. So that's on the current score. The Vantage 4.0 and the FICO 10T, that's still at least a year, maybe even 2 years away from being implemented.
So let's say I have a borrower, he applies, he's got $5,000 in medical collections on his bureau. It's all reporting unpaid. I go get proof that they're paid and send it in for a rescore. Are you saying it will take in that new consideration and rescore that and actually make a difference? As in the past, sometimes it hurt it because it brought it current to a new current date.
Correct. So you may not even need to rescore that. So right now, as of April 1st, any unpaid medical collections under $500 is not actually being factored into the score.
But if it's over 500,
yes, then we should get it updated to paid. And then once it's showing 0, then it's also not factoring into the score. Unlike before, like you said, when you pay off a collection, it's still hurting your score because now it's refreshing the report date of the collection, and sometimes that's going to even be worse. So that won't be the case anymore starting this month.
What about judgments? We see judgments on credit bureaus. How's that affecting our score?
So judgments and liens actually no longer show up on credit reports. That's something that happened about 2 years ago. So you won't see it on the credit report, but if a lender is pulling a separate report called a liens and judgments report, then that will show up, but that no longer has any impact on the credit score because it's not part of a credit report anymore. It's a separate report.
Great. So are you saying that you see in the future going away from a tri-merge and going to more of a bi-merge or just two bureaus? Is that what you're?
Absolutely. So I'm not saying that, but yes, FHFA has approved a change from your 3 tri-merge system to a bi-merge system. So in the next few years, we're not going to be required to pull a tri-merge anywhere. The Fannie and Freddie are going to use 2 scores to underwrite a loan. Right now, we're not sure how that's going to work because we know that the 2 scores they want to use is going to be the FICO 10T and the Vantage 4.0. But does that mean that we can still pull a tri-merge and then select the top 2 scores, or will we just be pulling 2 from the beginning and then submitting it as a 2 bureau? So all that's still unsure because it's still kind of in this pilot testing phase. But we do know that a tri-merge is going away and it's going to become a bi-merge, at least with Fannie and Freddie.
It'll be interesting to see how that all shakes out. Do they just take the lowest? Is it blended? Are they going to be, because they're looking at data a little bit more closely, or, I see regions where regions do, all report to this bureau and et cetera. So this score could be higher or lower, just depending on, the situation. Do you think that these 2 bureaus with everything in factor will be just more consistent, and so the scores will be very close to the same?
I think so. I think because both of the new scoring models are incorporating the alternative payment history. So now you're going to have rental payments, you're going to have utility payments, cell phone bill, Paycom bills, in addition to trended data, in addition to your existing accounts. So really, both scoring models are now consistent with each other more than how the current model is. So we should get scores that are going to be more in line with each other. But what I've read about the score, how it's going to impact us is if you have higher credit scores to begin with and you have a good payment history with no lates in the last 24 months, you're probably going to score better on the new scoring model. You'll get a higher score. But if you have some late payments in the last 24 months, lower credit scores to begin with, then the new scoring model might score you lower for that base of people. With that said, though, it's still going to include more potential borrowers because those that would not have qualified in the past under the current scores may now be able to qualify due to the alternative payment history being part of the score. So it's still, hopefully that's still going to be better for the whole mortgage industry.
A couple little questions. Yes, medical debt 500 and under will automatically be removed from the credit report or will not count in the score.
It it's supposed to be automatically removed, but we're not seeing that happen right now because it's with the bureaus. I mean, it's something that even though it's on, it's written in the policies, it's not as easy to implement in real life. So if you're not seeing it drop off automatically, you should reach out to the bureaus and say, hey, this medical collection is still on my credit report, and dispute it. And they'll take it off because they know that's the policy. Okay.
Yep. I think I kind of mentioned it, but one of the questions was why are all three bureaus so different? And I think it's who's reporting to the bureau. More importantly, then they have different ways to be able to create a score. I think they all create the score the same way. It's just some companies only report to one or two, or some report to all three, and it really reports on who's reporting information to what. Is there any other advice or how we can answer that question differently?
Well, Chris, it looks like you've been doing your research on credits because you got it right. No, you're exactly right. It's because they have different information reported to each bureau. You may have Equifax may have a collection account reported to them, but that collection account's not reported to the other two bureaus. So of course the score is going to be lower for Equifax and higher for the other two. So the difference is contributed to the different information that each of the bureaus have reported to them, not necessarily the different way that they're calculating the score.
Yeah. One of my favorite marketing things to give to buyers is that the 10 biggest mistakes smart people make when buying a house. And I thought, man, oh man, when I was thinking about you this morning and driving to work, I'm like, okay, what are a few credit myths that we as mortgage brokers screw up?
Yeah, well, okay, and that's a good one. I mean, we hear, for instance, and a lot of this I hear from LOs and brokers advising their clients of what to do. And then when it comes back to me, and after it's too late, and I say, I wish you would have asked me first, because because that was not the right thing to advise, basically.
Yeah.
Number one, right, closing accounts. And that's a big one. I mean, a lot of times, brokers may tell their clients, you got a bunch of these accounts. Let's just close all these accounts, close all these accounts.
Mm.
And guess what? That doesn't help your credit score. Closing your accounts may have a negative impact on your score, because with these open accounts, you also have a lot of available credit limit. So the more available credit limit you have, that's going to lower your balance to high credit ratio overall. And that's a good thing, right? That means that you have a lot of available credit limit. You're not overextending yourself, and that's helping your score. But once they close all of these accounts, all of this available credit limit is now gone, and now your small balance is now considered possibly maxed out or a higher ratio, and that can impact your score. Also, closing accounts will, all of your active history you have on these open accounts, once you close it, it kind of stops and it doesn't help you as much. So there's two factors there that that could be impacting your score in a negative way if you're closing a bunch of accounts. So that's one big myth. A lot of people just think that helps you, but it doesn't help you. Another one we mentioned earlier, paying off a collection account. Back then you pay off a collection account, that hurts your score. That won't help your score. So that was a big myth. So I think most brokers now or LOs know that it's not a good thing to pay off a collection unless you can get it deleted. So you always want to negotiate the deletion as a condition to paying off a collection, and that will help. If it gets deleted, that's going to help.
Now, someone said to me, "Oh, is that legal to ask for them to delete the collection?"
Mm-hmm. Absolutely. Now, the collection agencies,
it's not illegal.
No, absolutely, it is. It's not illegal. You can absolutely ask for the deletion of a collection. What the collection agency will tell you is that it's illegal, and I hear that all the time.
Mm-hmm.
They'll cite some provision saying we cannot delete a collection, but that's not true. We see collection letters every day to delete their own account. So you can absolutely ask for that, and they can absolutely do it.
Cool. Give me one more myth. I love these.
Let's see. Inquiries is a big one. I think there's a grace period for inquiries, right? So every time you pull someone's credit, a mortgage credit, there's this grace period, and not and everyone thinks that the grace period's the same for all three bureaus. They think it might be 30 days or something, but that's just an average. The actual grace period for inquiries.
Let me guess.
Yep.
14 days.
Close.
All right.
15. So 15 days for Experian, and Equifax and TransUnion is 45 days. So a lot of people just average that to 30, but specifically it's not. It's 15 for Experian, 45 for Equifax, 45 for TransUnion. So what that means is if your borrower is shopping for a loan and they're getting their credit pulled by multiple mortgage lenders, then it's not going to impact them any further during that grace period window. It's all of those inquiries will be treated just as one inquiry.
That is so good. That is great to know, because I had no idea that they were different.
And the only reason that's important is, I mean, what if your mid-score, if the mid-score is Experian, and now you're outside that 15-day window to repull credit for Experian, that score may drop and your mid-score may not be your mid-score anymore. So yeah, I mean, those are things to consider. But there is a difference between the grace period for mortgage inquiries.
Yeah, so they wanted us to repeat it again. Experian is 15 days.
Correct. Experian is 15, the other two, 45.
So one of the questions come in, I know enough to be dangerous, you'll know the rest, is that, you know, when do credit bureaus update information? And one of the things that I want to start with, and then Gordon, I want you to finish, is that the credit bureaus are only as good as the information that gets provided into them. So we have a credit tape. We update our credit tape. They come in and zip that credit tape, which then goes into the credit bureau. But then, you know, technically that credit bureau updates when? And do they all do it the same?
They don't report at the same time. It's going to be different for every creditor, and even within an institution, like let's say Capital One, they have different types of cards. You know, Amex has different types of cards. So they're all going to report at different intervals throughout the month. We don't know when each credit card reports. We don't know when each creditor reports. We only know they report once a month, and it could be any time. So it's hard to predict that.
So just to, you know, reiterate what Gordon says, is that it's not the credit bureaus updating the information. It's the creditors updating their information into the credit bureaus is the deal. And that's when you just don't know. I mean, you know, us as a bank, we've set this date and this is when we send it all in. And credit, which I didn't know, Gordon, is each credit card and each product could have a different upload.
Correct. Yep. And even if as a creditor, like your company, if you're reporting to the bureau, you're sending your data to the bureaus on the 15th of each month, it doesn't mean it's real time either. The bureaus have their own processing time frame. It goes through some cycle on their end. So it may not update until the 20th or the 25th or some other date. So, you know, it's hard to time something like that.
Yeah, one of the questions said, so it's not true if the creditors report on the day of the statement. I think I don't know if that's probably true, but it's that they report the information that's on that statement, but when they report that information is probably, would you call it a mystery?
Yeah, and I think that may be a good date to go off of if you don't have any better date to use. So, but that doesn't mean that the credit report is going to be updated, you know, based on the date of the statement. So there could still be some sort of processing time frame, maybe even 10 days lag time before it's actually updated on the credit report. So yeah, you don't want to just base it on the exact date of the statement.
So 10 days would be a safe. My statement ends on the 19th. I know on the 29th, I probably am safe to be able to update that bureau.
We actually advise waiting 30 days from that date, but that's being conservative because we don't want to advise someone and then they pull credit and it's not updated. So we're just being safe, but it could be sooner. Certainly could be, you know, 10 days, could be 15 days, but it's definitely not going to be the same date as the one that's showing on the statement.
Cool. Look, I'm going to make sure I put all of Gordon's information in there to be able to get connected with the company. I think Gordon's a great partner. Here's what I like about Gordon. He ain't no spring chicken. He ain't no spring chicken to the mortgage industry. He understands mortgage brokers. He understands what you're going through, and his company wants to help. So if you're using another company that's not that good, not that experienced in the mortgage industry, maybe you need to be looking at Gordon, even though he owes me $5,000.
I'll make it up to you at the boot camp. I'll buy you
At
a
the
drink,
boot
Chris.
camp. I am so glad. You know what? Your debt has been paid. Look, we got to make sure you come to the boot camp. I'm all about looking in the windshield, not the rearview mirror. Here's the thing about originators. You can't originate if you're sad or mad. You're not attractive. No one wants to work with you. And there's a lot of originators out there. They're sad. They're mad. They're trying to figure out a way to change it. The only way you can change it is you got to change the play. You got to get new stuff, new material, new connections, new relationship. And the boot camp is the place to get that. Plus, Gordon's going to be there. He's going to take care of all your questions. He's a great sponsor. We're excited to be able to have you hang out with you, Gordon. I know you find out where I always have dinner and you just show up, right?
Absolutely, because you go to the best places.
Gordon, thank you so much. We really appreciate it. Thanks for being on today. Loved it. I learned so much, and I can't wait to continue to learn because look, credit bureaus are a big part of our industry. It's how we get our credit. It's how we get our customers approved. And the more we know about it, the more we have a better chance to get our customers approved. Wouldn't you agree?
Absolutely, Chris. And thank you for having me on the show. I had a blast.
All
Always
right. Well,
nice
enjoy that
interacting with you.
Peloton.
Thanks.
See you later.
Bye, everyone.
Bye-bye.